You know, we're all told the same thing. Corporate bonds are the ultimate safe investment. They're supposed to be the bedrock of a conservative portfolio. But what if that safety's just an illusion? What if that solid foundation actually has a crack running right through it? Well, in this explainer, we're going to dismantle that myth of the perfectly safe bond. And more importantly, we're going to give you the tools to see the risk for what it really is.
Okay, here's our game plan. First, we'll cover the allure of bonds, why everyone loves them. Then, we'll dive into when safe isn't so safe. Next up, we'll open the investigator's toolkit, figure out how to price risk, and finally, we'll talk about what a real safe haven actually looks like.
All right, let's kick things off. Why are bonds so darn appealing? I mean, what's the big draw? It really just boils down to one simple, powerful promise: stability and income.
Yeah, this quote right here, it just nails it. Think about it. With stocks, you're on a roller coaster, right? It's all about volatility. But bonds, they're supposed to be the complete opposite. The steady, reliable workhorse. You're not chasing those explosive gains. You just want something you can count on. You want reliability. So what is a corporate bond? Really? At its core, it's actually super simple. You're basically playing the role of the bank. You lend money to a big company. They get to use your cash to run your business, to expand, whatever they need. And in return for your loan, you get a nice, predictable stream of interest payments, and then, at the very end, you get your original money back. It's one of the most fundamental ideas in all of finance.
And look, it's not just regular folks like you and me buying these things. The entire financial world is practically built on this concept. We're talking about huge banks, massive insurance companies, all those professional portfolio managers. They all hold mountains of corporate bonds. It's a core, non-negotiable part of their strategy, all for that sweet, sweet stability.
Okay, but here's where the picture-perfect story starts to get a little messy. That promise of getting your money back, well, it's just that, a promise. And as we all know, sometimes promises get broken.
This right here is the question in bond investing. What if they just don't pay you back? That's it. That's credit risk in a nutshell. It's the chance that the company you loaned your hard-earned money to just goes under. And then, all of a sudden, your safe investment is anything but. That reliable income stream? Poof, gone. And you might not even see your original investment again.
And believe me, this isn't some textbook theory. It happens. Just look at the recent case of Credit Suisse. I mean, this was a massive global bank, a name you thought was a pillar of stability. But as fears started swirling about its financial health, the market got spooked. People started asking, hey, can these guys actually pay their debts? And when that fear takes hold, the price of their existing bonds just tanks. It makes perfect sense, right? If you were to buy a new bond from them today, you'd demand a way higher interest rate for the risk. So who's going to want to buy their old bonds that pay less interest? Nobody. So the price has to drop.
And just look at how bad it got. At the absolute peak of the crisis, the market was pricing in a 23% chance that Credit Suisse would default. 23%. Let that sink in. For a bank that was supposed to be a cornerstone of the entire global financial system. So much for guaranteed safety, huh?
All right, so things can get scary. The risk is definitely real. But, and this is a big but, that doesn't mean we're just sitting ducks. It's time to stop talking about the problem and start talking about the solution. So let's open up the investigator's toolkit and learn how to decode this stuff for ourselves.
You've seen these bond ratings before, right? Letters like AAA or BB, but what on earth do they actually mean? Well, they're not just random letters pulled out of a hat. This table here, it's like a secret decoder ring. It translates those letters into the actual historical chance of a company defaulting. Take a look. An S&P BB rated bond. That's kind of the first step into what they call junk territory. Historically, those have a 30% chance of going bust. 30%! And if you go all the way down to a C-rated bond, we're talking a mind-blowing 70% chance of default. Suddenly those letters aren't so abstract, are they? They're cold, hard odds.
And that's the whole point right there. The numbers tell the real story. Don't just glance at a letter grade and move on. You've got to know the odds behind it. I mean, knowing a bond has a 30% historical chance of failure, that hits a lot different than just seeing the letters BB on a screen, doesn't it? But hey, you can go even deeper than what the ratings agencies tell you. You can put on your own investigator hat and dive right into a company's financial reports, like the 10K. So, step 1, check their financial health. A great little rule of thumb is the current ratio. Do they have at least $2 in current assets for every $1 they owe in the short term? Step 2, you gotta understand the business itself. I mean, are you lending money to the next big thing or to a company that makes horse-drawn carriages? That context is everything. Step 3. Read the fine print. Seriously. The best nuggets of information are almost always buried deep in those 10K and 10Q reports. And finally, step 4. Look for the red flags. Is the CEO being super vague about how they're going to make money? Does the accounting look a little creative? Those are huge warning signs you can't ignore.
Okay, so we're getting pretty good at spotting risk. But how do the big shop professionals actually put a price tag on that risk, like right now? Well, they use a clever tool that acts a whole lot like an insurance policy. Let's break it down like this. With standard bond investing, you buy the bond and you cross your fingers and hope for the best. That's pretty much it. But in the pro leagues, they don't do hope. They buy the bond and they buy a separate insurance policy that pays them if the company goes belly up. It's called hedging, and it's a total game changer.
So, this fancy insurance policy has an official name. It's a credit default swap, or CDS for short. And honestly, it works just like the car insurance you buy. You pay a regular fee, that's the premium, and in return, you're protected if something bad happens. In this case, that something bad is the company defaulting on its bond. And just like car insurance for a teenage driver is more expensive, the higher the risk of default, the more you're going to pay for that CDS premium. And this is where it gets really, really cool. By tracking the price of these CDS contracts, we can literally watch the market's fear level tick up and down in real time. Let's go back to our Credit Suisse example. At the start of the year, the cost to insure their bonds was about 60 basis points. That's just a fancy way of saying 0.6%. But watch what happened during the crisis. That premium exploded to 355 basis points. That's over 3.5%. What you're looking at on this chart is basically a real-time fear gauge. The cost to insure that safe bond shot up by almost 6 times. Incredible.
All right, let's recap. We've busted the myth of perfect safety, we've learned how to be a risk detective, and we've even seen how the pros put a price on fear. So now, it's time to put it all together. Let's talk about building a smarter, truly resilient defense strategy.
You really got to let this one sink in. This is the brutal, honest truth. This whole idea of a perfectly safe or crash-proof investment that will protect you no matter what happens, it's a fantasy. It just doesn't exist. And you know what? The moment we accept that, we can stop chasing a ghost and start building something that's actually real, something that's built to last.
So, what does that real strategy look like? It really rests on 2 main pillars. Pillar number 1 is just good old-fashioned analysis. Do your homework, people. Study the facts. And here's the key. Stay inside your circle of competence. If you don't understand how a business makes money, for the love of God, don't lend it your money. Simple as that. Then you have pillar number 2, diversification. This is your only real defense against what they call the unknown unknowns, the risks you can't even see coming. And I mean real diversification, not just buying bonds from 20 different tech companies. I'm talking about spreading your money across totally different asset classes, stocks, bonds, real estate, the whole shebang.
Look, at the end of the day, this is the big takeaway. Stop looking for a silver bullet. There isn't one. No single investment is truly crash-proof. The real goal here isn't to build some kind of impenetrable fortress of perfect safety. The goal is to build a resilient portfolio, one that's strong enough to bend when the storm hits, but not break so it can recover and keep working for you over the long run.
So I'll leave you with one final question to chew on. Take a good, honest look at your own portfolio. Is it actually built on a solid foundation of real analysis and true diversification? Or is it just resting on the comfortable but maybe fragile idea of safety? Think about it.